Good evening. Fast food stocks on the Australian share market are under pressure as the cost of living squeeze continues to change how consumers spend. Shares linked to pizza, fried chicken, donuts, coffee, and quick-service restaurants have fallen sharply on the ASX, with investors growing concerned that even traditionally affordable meals are becoming too expensive for stretched households. The pressure has hit several well-known names, including Domino's Pizza Enterprises, Collins Foods, the operator of KFC restaurants in Australia, and Retail Food Group, which owns brands including Doughnut King and Gloria Jeans. The concern is simple. When household budgets are tight, consumers cut back first on discretionary spending. And for many families, takeaway meals, delivery orders, and coffee runs are now being treated less like everyday habits and more like occasional luxuries. Domino's Pizza Enterprises has faced renewed investor pressure after weak trading signals from the broader Domino's business, with consumers pulling back as food, energy, and transport costs remain elevated. Reuters reported that Domino's Pizza lowered expectations for annual global sales growth, citing weaker consumer spending and inflation pressure. The weakness has also affected Collins Foods, whose earnings are closely tied to demand for KFC, and Retail Food Group, which is exposed to donut, coffee, and casual food spending. The Guardian reported that fast food shares on the ASX have been hit as rising living costs force Australians to rethink what they spend on convenience meals. For years, fast food was seen as relatively defensive during economic slowdowns. When consumers avoided expensive restaurants, they often traded down to cheaper takeaway options. But analysts are now questioning whether that pattern still holds. Delivery fees, menu price increases, fuel costs, and broader inflation have changed the equation. A pizza night or fried chicken meal that once felt inexpensive can now represent a more noticeable hit to the weekly budget. For investors, the bigger concern is not just one bad trading day. It is whether these companies can continue growing sales while customers become more price-sensitive. That puts pressure on margins. Fast food operators are dealing with higher wages, rent, ingredients, logistics, and energy costs, while also needing to offer discounts and value deals to keep customers coming back. The result is a difficult balancing act. Raise prices too much, and customers walk away. Discount too heavily, and profits come under pressure. The market reaction suggests investors are becoming less confident that fast food chains can easily pass rising costs on to consumers. There is also a broader signal here for the Australian economy. When households begin cutting back on low-cost convenience spending, it suggests the cost of living squeeze is reaching deeper into everyday behavior. For consumers, the shift may mean fewer delivery orders, fewer impulse food purchases, and more meals prepared at home. For companies, it means the battle for value-conscious customers is becoming more intense. And for the ASX, the decline in pizza, chicken, and donut stocks shows that consumer pressure is no longer limited to big-ticket items. It is now showing up in some of the most familiar corners of daily life. This has been your market update. The key question now is whether fast food brands can win back budget-conscious consumers, or whether the cost of living squeeze will continue to weigh on sales, margins, and share prices.